A central banker can say just 2 words at a dinner, and news screens around the world will flash in alarming red within minutes. This swift reaction illustrates how vulnerable our confidence can be, especially when prices have surged far beyond their historical benchmarks. Speculative booms take shape when rising prices seem to validate the trend, prompting more individuals to consider buying as a clear-cut choice. A narrative develops to justify the price increases, which quickly proliferates through conversations, headlines, and repeated charts. When beliefs go beyond the underlying fundamentals, not only retirement plans, but also corporate investments and public policies can be influenced by misleading perceptions. Subsequent declines can harm households, endowments, and government finances because inflated expectations were based on atypical price levels. In both offices and living rooms, people monitor every market tick, exchange trading tips, and watch others revel in quick successes. The atmosphere appears rational, yet decisions subtly shift towards riskier ventures and away from thoughtful, long-term planning. Soon you'll understand how bubbles develop, intensify, become rationalized, and how to react without falling into denial. This video draws inspiration from Irrational Exuberance by Shiller, so subscribe to the channel for sharper insights into market dynamics. A speculative bubble is a phase where price surges create excitement that spreads from person to person. This phenomenon operates through psychological contagion, where rising prices fuel convincing narratives that attract participation. As more buyers enter the fray, feelings of envy and a gambling mentality can overshadow any doubts about the inherent value. This influx of buyers drives prices even higher, reinforcing the narrative that the rise is undeniably valid to newcomers. Surveys indicate that consensus can solidify quickly, as nearly everyone echoes the same simple investing principle. In the market peak year 2000, an astonishing 97% believed that stocks were the top long-term investment. Once prices declined, that agreement waned, revealing how long-term optimism can be swayed by price trends rather than facts. Understanding this pattern is crucial, as it clarifies why bubbles do not necessitate universal certainty, just shared focus. Treat sudden unanimity among investors as a warning sign, and consider what evidence might shift opinions if prices were to plateau. For every investment, write down one rationale based on valuation and one rooted in behaviour, and review them during calmer times. Feedback loops serve as the engine that transforms past gains into present excitement and future demand. Rising prices capture attention, which in turn drives buying behaviour, and this buying becomes news that entices even more buyers. To grasp this logic, think about a Ponzi scheme where returns are funded by the deposits of later investors. Early participants share success stories, attracting new investors, allowing the organiser to continue payouts until growth inevitably stalls. This setup mirrors regular markets, where investors chase recent performance, even absent any deliberate deceit. The crux of the matter is narrative amplification, as stories of easy profits travel faster than careful analysis. During a rapid housing boom, many respondents in surveys attributed price movements to economic narratives rather than psychological factors. This disconnect allows feedback loops to endure longer, as people believe they are responding to fundamentals while simply following each other. Pay close attention to feedback loops in your thinking, especially when recent returns start to feel like an unchangeable reality. Shift your focus from chasing trends to evaluating the cash flows or rents that justify the current price. Media doesn't just reflect market conditions, it shapes the attention and frameworks that investors use to understand events. A constant stream of price updates creates a compelling narrative, allowing coverage to amplify yesterday's feedback into today's actions. One method involves linking explanations to price movements that the public has already noticed, thereby increasing their significance and sparking conversation. Another is the phenomenon of an attention cascade, where repeated reporting gives even weak claims a sense of importance. In the early 1980s, Joseph Granville hosted flashy seminars and provided buy or sell recommendations to his clients. Following reports that his advice had shifted, the Dow experienced sharp increases or decreases, often without additional significant news. This illustrates how narratives about influence can drive prices by altering perceptions of what others are likely to do. The outcome isn't merely manipulation, it's a battle for attention that favours drama over solid metrics. Create a media filter by distinguishing between objective data and interpretative narratives, while also tracking the frequency of story repetition. If you're seeking effective tools for market analysis without getting swept away, continue subscribing and learning through this series. New era thinking arises when people perceive the future as more promising and less uncertain than the past. These perceptions appear in waves rather than as a consistent trend, making them easy to mistake for lasting change. When a story gains traction, it can validate inflated valuations even when the underlying numbers don't support such conclusions. As similar narratives have emerged previously, there is a risk of overreacting to the novelty and overlooking established patterns. During the mid-1990s, the internet was widely regarded as a game changer for productivity. Some analysts believed this shift indicated that traditional valuation metrics no longer applied to stocks. This narrative interacts with feedback, as rising prices provide visible confirmation that a new era is genuine. Once the story gains momentum, skepticism can feel disrespectful or uninformed, causing dissent to diminish even among experts. Challenge any claim of a new era by listing what must remain true for a decade and what factors would prove it wrong. Then base your decisions on measurable ratios, diversification, and a humble approach to forecasting, instead of alluring narratives. Markets struggle to stay anchored to fundamentals, as most participants are unsure of the appropriate expected levels. Psychological anchors such as round numbers, recent peaks, and intuitive comparisons often fill that gap. While these anchors may temporarily slow price movements, they can rupture suddenly when overwhelming feedback occurs. This is why prices may stagnate within a specific range and then suddenly shift as attention and beliefs align. One useful valuation metric is the CAPE ratio, which analyzes price to earnings over extended periods. Historical data shows that years with low CAPE ratios tend to precede higher 10-year returns, while high CAPE years often see lower returns. Just before the 2000 peak, CAPE soared to unprecedented levels, indicating prices that were unusually high compared to earnings. An alternative perspective suggests that markets are efficient, with prices moving in random patterns that reflect all available public information. This ongoing debate is crucial as it influences our confidence in valuation indicators versus the idea of pure unpredictability. Use valuation anchors intentionally by adhering to long-term strategies, modifying exposure during extreme valuations, and steering clear of blind trend following. Speculative volatility is not merely an afterthought, it is a recurring element in modern finance and culture. The aim isn't flawless prediction, but rather the creation of systems that mitigate damage when optimism or pessimism takes hold. You have witnessed how bubbles can develop through contagion, feedback loops, media focus, and persuasive narratives about a new era. You have also seen why psychological anchors and valuation tools like CAPE can help establish expectations over extended periods. Clearer expectations can help temper overconfidence, reduce the chances of panic selling, and enhance the likelihood of disciplined saving. Policy should not begin with halting market activities, as markets are essential for resource allocation and support genuine economic growth. In a free society, the government cannot protect individuals from their own mistakes without compromising fulfillment and choice. More effective responses include better regulations, enhanced social insurance, and institutions that allow for improved risk management. On a personal level, resist becoming complacent after successful years, and keep your plans grounded in realistic expectations for long-term returns. If these insights into market psychology are valuable, consider subscribing for more episodes that translate volatility into actionable decisions.